Alright folks, it's Wednesday, July 31st. I got a lot to cover here, so let me get right to it. Fed did a 25 basis point rate cut as I expected. I've been saying that in my videos here for a number of weeks, and it's ending its balance sheet roll-off. So here is the breakdown. First of all, I want to let you know that prior to today's action, I sent out an email to my subscribers, both MMT Trader and Zombie Trading. I said the reaction would be bullish for the dollar, it will be bearish for gold, and that's exactly what happened. Now let's step back and take a little bit of a broader view of what's going on. First of all, the rate cut itself is, I would say, marginally bearish or disinflationary. Remember, this goes along the lines of rates are a form of price setting, all right? So a rate cut is price setting lower. That's how come all these countries like in the Eurozone and Japan, and by the way, we just saw Turkey, that if I could just make a little aside comment here on Turkey. Today, the Bank of Turkey, the central bank, said they are lowering their inflation projections. And guess what? It's because they cut interest rates. And every mainstream economist out there, not the MMT people, but all the mainstream economists out there, when the Turkish central bank said they were going to start cutting interest rates, they went berserk, these economists, because they said, no, that's going to stoke inflation and it's going to cause the Turkish lira to collapse. And they were absolutely 100% wrong. I told you when they started to do that. I made some videos that said the Turkish lira is going to go up, the inflation rate is going to come down. Same thing you have happening here now with the Fed. So there's a number of effects here. Number one, it is price setting lower by virtue of the fact that they cut the rate. The price of all goods and services reflect the cost of credit. When the Fed lowers the cost of credit, prices come down. It is not inflationary as mainstream economics likes to preach. It is the opposite. It is disinflationary. That's how come you saw the pop in the dollar and gold come down as a result. I'm going to talk about those two things in a second in a little bit more detail. The stock market's reaction was correct, although overdone. The sell-off in the stock market reflects the fact that we are having this disinflationary force come in. Number one, the end of balance sheet roll-off means that the Fed will no longer step back and allow the economy to be replenished with high quality assets, treasuries, okay? It is going to be back in the market. It's not going to be doing QE, thankfully, but it is going to keep reserve balances at the level where they are right now. It is not going to be bringing reserve balances down any further. At least that's my interpretation. Now, what emerges from this, and remember, I've been talking about this for months now, the fact that the debt ceiling combined with the Fed's engineering of reserve balances down has driven the bonds into, have driven the banks, sorry, into the bond market because they had to replace those lost Tier 1 assets, the reserves, with other Tier 1 assets, which were bonds. That phenomenon comes to an end now, and hopefully by sometime today or tomorrow, the Senate will vote on the budget and debt ceiling bill, and we will get a resumption in bond sales. So the rally in the bond market, the decline in interest rates, that is near over. Okay, that is near being over. So what this means is that with reserve balances no longer being drawn down, okay, the banks will be able to move into more risk assets, meaning loans. So you will start to see credit creation accelerate. And this is something which we have seen a little bit of since November of last year, but we should start to get a significant acceleration in credit creation now. All right? So that has positive implications for the economy. The downside is you will see households, their level of debt will rise, the level of debt service will rise, but it's still very, very low historically, at least debt service as a percentage of disposable income. The other thing that we see here with a decline in interest rates is that you will see multiple expansion in the stock market. That means stock prices will advance more rapidly than earnings, and this is where you get that real speculative extension of the rally, where the stock rally becomes much more speculative in nature. So we are not at a top. Today's sell-off in the stock market was a little warning shot. It says that, hey, the cut in interest rates is deflationary, disinflationary, however you want to call it. As for the dollar, let's talk about the dollar now, because, you know, I've been short the dollar since December, 2015. The dollar index made a marginal new high. I think we got up to 98.68 or something like that. The prior high, I believe, was 98.38 or something like that. So a marginal new high. I still believe that the combination of large fiscal deficits combined with large trade deficits limit the dollar's upside. All right? So let me just state that. I understand the dollar's rally today based on the rate cut. However, there are other elements to the fundamental picture, and that would be fiscal deficits and trade deficits. As far as gold is concerned, the sell-off today was in sympathy with the dollar. It is also gold reflecting the fact that the Fed's rate cut is deflationary, disinflationary. However, I will say that gold has certain fundamentals going for it right now. Number one is very low levels of new mine supply. That's because we have not seen any significant investment into mining over the last 8 or 9 years. I've been talking about this. And number two is the fact that we are seeing globally central banks accumulating more gold. Now, obviously, these are bigger, long-term pictures, and the gold outlook in the near term is probably a little precarious. We could get a correction, most likely, based on the rate cut. But the longer term fundamentals of gold, I believe, remain sound. And by the way, might as well mention something about base metals, which have been really kind of in a bear market since this whole China trade war fiasco that's been going on over the last, 17 months or so. I think it ties in with the Fed's ending its balance sheet roll-off and what I believe we'll see as an acceleration of credit growth. So I think there's a bottom being made with base metals, industrial metals. We'll see how that plays out. So to sum it all up, 25 basis point rate cut as I predicted. We went long for a quick trade on the dollar today based on that, and the zombies, you know, they were gonna sell the dollar, and of course it went up. Bigger picture, dollar still has to contend with fiscal deficits and trade deficits. Gold has bullish fundamentals. Stock market, we are going to get into a more speculative phase of the stock market. The rally isn't over. And today's sell-off, whatever, 380, 370 down at one point, I'm not seeing where it is right now, that was overdone. One more thing, let me just read something off. I got a very nice email today. If you don't mind, I got to put my glasses on, from a subscriber. And I'm going to read it to you because it was really, really very nice whenever I get these kind of things. Here we go. Oh, where is it now? Yes, isn't this... Oh, here we go. Mr. Norman. Hang on. Sorry about that. Mr. Norman, since your YouTube May video on Buy the Dip, my account went from 18,000 to almost 30,000 by July 30th. I don't believe you are 100% accurate, as variables are beyond reason in the market, open parentheses, zombies, close parentheses, but I give you 90% accuracy, and that is phenomenal. Keep up the excellent work, and much blessing to you. Pretty nice, huh? The guy's, in a very short period of time, 2 months, almost doubled his portfolio. He's a subscriber. All right, everybody, go to pitbulleconomics.com, sign up for a 30-day free trial of MMT Trader or Zombie Trading. See you tomorrow. Bye-bye.